Well, good afternoon, everyone. Welcome to Day at the Races 2016, our employee benefits update. I'm James Moyna from JMM Thank you all for coming. We're pleased to have you here today. We've got some interesting speakers, present company excluded, coming this afternoon. And I think you're going to enjoy the program. I'm going to get us started off with some regulatory and audit updates. But as is customary for those of you that have been here in the past, I also kick us off with some really poor humor, and it's also poorly delivered. So you have that to look forward to. So how about this? Did you guys hear what happened? Did you hear, what the auditor did to liven up the annual office party?
Invited some actuaries.
Ooh, close. But no, he stayed home. Unfortunately, I didn't stay home today, so you're stuck with me for the next 20 minutes or so. So again, welcome. Thank you for coming. I'm going to tell you about some things going on in the plan audit industry, which is the industry that I work in. Auditing retirement plans, the audits that are attached to your Form 5500 filings each year. As far as an update, the Department of Labor has been going out for the past several years now, and they've been doing an audit of the auditor. So they've been going to accounting firm offices, selecting some files, and reviewing them, and making some sort of assessment of the quality of the work product. And the most recent one found that there was a failure rate of 40%. Whoa. So you can see on the slides, you have these in your handouts. You can look at the entire report. It's 190 pages long, so I'm just going to recap it here in about 2 slides. So as you can appreciate, that is a very high failure rate. Here are the results of the last 4 studies that the Department of Labor has conducted. And you can see, dating back to 1988 was the first one we have statistics on. They found about a 23% failure rate, which is pretty high. Down a little bit in 97 to 19%. And then, jumped up 2004 to 33%. And most recently, 39%, nearly 40%. So the DOL went out to accounting firms, said, hey, we've looked at these files, and 4 out of 10 of them, we believe, we as in the DOL, believe that these audits are deficient in some way, shape, or form. What does that mean for you? Why do you care? As plan sponsors, some of you may have received last November an email from the chief accountant at the Department of Labor that discusses these findings. And here's a little excerpt from that email that was sent out, talking about the failure rate and then mentioning that substandard audit work can be costly to plan administrators and plan sponsors. That would be you folks. And why is that? The DOL, although they did this review of accounting firms' work, doesn't have regulatory authority over the accounting profession. They do have authority over plan sponsors. So if yours happened to be one of those files they looked at and didn't care for too much, they're probably going to come back to you and notify you that your 5500 filing was deficient, corrections need to be made, things need to be fixed. And then you're going to get to have that wonderful conversation with your auditor and discuss who's going to do that, et cetera. So the DOL has reached out to plan sponsors about this study and is pointing to them and looking to them to get it corrected. So why is this? Why is it that quality has been so low and seems to be actually getting worse instead of better? I'm going to give you, my thoughts, ideas, and opinions. I've been doing this auditing benefit plans since 1999, 16, 17 years. I've been auditing plans only. So I think I've almost seen it all. And every time I say that, I go home and I get another call or email, and I go, wow, where'd that come from? So I see all sorts of things, from going to review prior auditors' work papers that don't exist. Oh, we had a flood. We lost those work papers. Right. They don't exist, probably because there wasn't much work done. So let's talk about typically the way plan audits are done and under the model under which these audits get done typically. So the traditional model is, as you might imagine, for the typical accounting firm that provides full services, tax, audit, consulting, etc. They are very busy January 1st to, say, May 1. May 1 comes and people are looking to take some vacation, some well-deserved rest, maybe looking for another job with a little more work-life balance, etc. So typically the first thought that many might have about doing a 401k audit is, let's file the extension, which is due at the end of July. This then tends to push field work into August. The report delivery due date is now going to be October 15 on extension. That's fine, maybe, unless something goes amiss. What if there are some things that need to be corrected? What if there are some contributions that need to be made? What if there are certain errors that need to be fixed before the audit can be signed off on? Pushing that work past that July 31 deadline really puts a strain time-wise on those sorts of audits, and I think tends to drive quality down. You also have staff turnover. Again, happens typically in those summer months. Perhaps staff that has never audited a 401k plan before. They know auditing very well, but they might not know things about ERISA. Compliance testing sorts of issues, 5500 types of issues, etc. Those things can lead to poor quality. And then also little or no time for plan sponsors to be able to review the financial statements that they're going to attach to their Form 5500. I'm guessing some of you may have gotten reports on or near that deadline with the simple, attach this to your filing and we're all done. Well, that's nice, but those financial statements are the financial statements, they're yours. The only piece that belongs to the auditor is the auditor's opinion on them. So I think it's important that plan sponsors get those reports early as possible in draft form, that perhaps someone sits down and goes through with them where the information came from, why it's in there, etc. So there's a complete understanding of what your financial statements contain and where it came from. But under that traditional model, unfortunately, that sometimes gets missed. So, how pervasive, might that traditional model sort of look be? I just, out of curiosity, took a sampling of some publicly available data to, reduce it to numbers, right? I'm an accountant, right? We're numbers people. So I just took a small sampling. This was about 25 plans. I looked at them and I said, how many of these reports were issued October 1st or after? So October 15 was the extended deadline. And in that sample, 71% of those reports I looked at were issued October 1st or through October 15, which again kind of supports or gives you some sense of just how many of those reports are going out right near the deadline. And in fact, 8% of them were issued after the deadline. So after October 15th, they were late. When you're in that area, as you might know, you're at risk of being actually penalized by the Department of Labor. And the penalties can be steep. They can be up to $1,100 per day that the report is late. Now, that rarely gets imposed, but it's used as a tool to force compliance, to force you to get them done, get them filed, get them taken care of correctly. So if you get pushed out past that deadline, you want to get it wrapped up as soon as possible. I think plan sponsors deserve better. You guys have a business to run. You've got lots of things going on. I think you deserve a little better service than what is currently being provided. To do that, I think it would be fair and appropriate of you to just simply ask your auditor for a schedule of the work that's going to be performed. Who's going to do what when? How are we going to keep this thing on track? How are we going to make the timing deadlines? You might want to ask some things about the audit team that's going to be working with your plan. Do they have any ERISA knowledge? Do they know things about qualification tests and so forth, 5500s, et cetera? Those things don't necessarily directly get reported on in the financial statements, but I know if you've worked with the auditors, you sometimes get questions that may or may not make sense. And they really need to know what to look for and what not to look for when they're performing those engagements. And then what sorts of things outside of the traditional audit services is the firm you're working with providing? Continuing education like we're having a bit of here today. What sort of value-added things might they be able to do above and beyond the audit? The audit itself can be very compliance-driven and whatnot, and certainly there's a report to be issued. But the auditor is going to be able to come to you with some ideas on improving your plan, maybe a look at some different options that you might have in the marketplace and that sort of thing. So go ahead and be sure to ask your auditors about that and what they might be able to provide in that regard. So what might be some of the implications of the Department of Labor's findings and whatnot? In that 190-page report that I referred to, I extracted a couple of things out of there. And that is the DOL is recommending that Congress amend ERISA, the definition of a qualified public accountant, to include some additional requirements and qualifications. Whether or not that'll happen, who knows, right? Talk to your congressman. Maybe never, maybe tomorrow, who knows? So essentially what the DOL is saying, we need to have some additional standards that we're going to hold ERISA auditors to allow them to go out and do these audits, because right now we're not seeing very, very good work. The DOL seeks to repeal the limited scope audit exemption. Probably almost all of you in this room, I would say nearly 90% or more of the audits that my firm does are limited scope in nature. Just because of the way it's named, adds a lot of confusion to what those audits need to cover and not cover. And it creates a lot of confusion in the marketplace and sometimes leads to firms simply not doing enough work because they're actually going to disclaim an opinion on the financial statement, which is actually a misunderstanding of the limited scope audit exemption. So the DOL is looking to just do away with it altogether. Accounting firms might be less likely to pursue plan audit work. We're seeing a little bit of that on my side. Some firms that we've done business with in the past is creating some opportunities for us, which is great, but it's just kind of narrowing the playing field. Some of the accounting firms are saying, we're just not going to do these audits because we struggle getting them done on time, et cetera, and we're just going to send that out to other firms. And it probably will have some upward fee pressure, as you might imagine. Firms are going to start saying, gosh, there are additional things we ought to be doing on these engagements. We're going to have to charge for it. So those are some potential implications of these increased oversight. So what sorts of things, I'm going to shift gears a little bit. What sorts of things do we find on these audits? You'd be surprised. I would say ballpark 20, maybe as many as 25% of the audits that my firm does each year, we find issues. And they typically, might seem rather minor, but they do need to be corrected in some way, shape, or form. To have a qualified plan is great, but you have to operate it day to day in accordance with what the plan document says, or it's no longer qualified. So now and again, we find issues that need to be taken care of. In general, we see oftentimes there's just a general lack of oversight. Maybe nobody specifically appointed as a committee responsible for the plan, a poor segregation of duties. In smaller companies, this is certainly something that's an issue. You only have so many people, right? But sometimes it's just, one person in payroll runs the plan. They do everything. They enroll people, they handle distributions, they handle their contributions, et cetera, and there's little or no oversight. I can certainly appreciate, the limited resources and whatnot, but to some degree there needs to be some segregation of duties and oversight over what that person's doing. Another big one that we see is simply just using the wrong compensation when calculating contributions. For example, bonuses and overtime. Your plan document is going to say whether or not those items are included or excluded from that calculation. And maybe it's been a while since you've paid out bonuses, and people have simply forgotten. They pay out a bonus and they forget to withhold 401k on it, make the match on it, et cetera. If something like that is discovered on an audit, it needs to be corrected and the contributions put into the plan, et cetera. Other things, forfeitures not being used timely. These are cut off a little bit on the screen, sorry about that. Deposits not being made timely. Required minimum distributions not being made, and perhaps plan expenses not being paid out properly. The plan can pay some expenses, as you know, but only certain expenses. So need to make sure that whatever the plan is paying for are appropriate use of plan assets. Any questions as I'm going through? Any questions along the way? Thoughts? Yes, sure. It's a very good question. Yeah. So the question is, what do you do when you find some sort of issue that might be a qualification issue? Does it need to be disclosed? Does it not be disclosed? Auditing is both science and art. So here's where we're going to move over to the art section of what I do. Great. It depends. So there's a concept of materiality in any audit. So first of all, okay, so let's say they did not withhold 401k contributions on overtime. So step one is calculate what those contributions would have been. And if it would have been, $3,000, you're probably not going to have a material situation that needs to be disclosed. If it comes out to be $3 million, now we're probably looking at something that's material and will not only be, accrued for on the financial statements, but also disclosed in a footnote to the financial statements. So it depends on the severity of the problem, the extent of the problem, how pervasive it is, how long it's been going on, and quite frankly, some of the interaction that we're going to have with plan sponsors on that in how seriously they're taking it and being willing to get it fixed. And do they have an ERISA attorney that can help out? Do they have a consultant that they can go to and help get those situations fixed? Because again, you've got a plan document that says this is how the plan is designed, and for these reasons it is tax qualified. But if you're not operating with what the document says, you're over here, you don't have a qualified plan. So when those two don't match up, they need to be corrected in some way, shape, or form. And to be quite honest with you, I typically refer that to an ERISA attorney. I don't want to be making those legal sorts of decisions. I'm going to have some ideas and thoughts on what they might want to do and make some assessment of whether or not the course of action that's being prescribed is appropriate. And then I, as the auditor, have to decide disclose, not disclose, et cetera. The other thing, too, they probably never do, but every now and then, you send out something called a summary annual report to your employees. If you look at that, it actually says they can request a copy of the audit. Well, every now and then, you're going to have someone say, hey, I'd like to see that audit report. And then, if they've asked for it, they're probably going to read it, and they're probably not going to understand it, and then they're going to ask you about it. What does footnote number 5 mean? What is this? So you want to know what footnote number 5 says and why footnote number 5 is in your report, so when they ask, you can deal with those sorts of questions. Thank you very much. Any other questions, thoughts, ideas? Okay, common findings, and I wanted to talk a little bit about some best practices for you. What can you do? I would say actually one thing you can do is come to events like this. You're all going to get, following today's session, you're going to get a little certificate of participation. showing that you are here today. You are, right now at this moment, fulfilling one of your fiduciary responsibilities. You are learning about plan qualification sorts of issues, how to operate your plan, some best practices, etc. That, I just read in an article on Monday, is one of the things the DOL is starting to ask for. What are you doing to educate yourself on how to operate your plan? Well, each of you can pull out your certificate of participation, day at the races. You lost $350 at the track, but you got some great education. So they're starting to ask, what are you guys doing to make sure you're up to speed on the things you need to know on how to operate a plan? So establish a plan committee. I see this a lot in smaller plans. There's just no committee. There's just somebody in payroll has withheld some deductions and sent them off to their provider. As plans grow, they start to, I need to actually have a committee, some people monitoring the plan, watching the investments, etc. So establish a committee if you don't have one already. Then meet on a regular basis. When you meet, keep minutes. Here's the day we met. Here's the things we discussed. Here are the decisions we made. Here are the things we have not decided on. We'll take care of it another time. So meet, document that you met. I would say, unfortunately, I don't get these invitations very often, invite your auditor to one of those meetings. Have them come, go over the financial statements with you, ask them questions. Be very happy to sit down and go through whatever questions you have on statements and help you understand them. Review your plan amendments. Sometimes we see an amendment happening over at the, CFO's office, and no one tells the person in payroll. And they maybe just change that definition of compensation. Well, payroll doesn't know. Review plan amendments and make sure that everyone that needs to know, that is affected by those amendments, is aware of what is happening. Obtain and review the user controls in your SOC 1 reports. Some of you might say, what in the world is a SOC 1 report? A SOC 1 report is an audit of your TPA's systems. So say Fidelity, Principal, the record keeper for your plan has probably had an audit conducted of their systems and whatnot and the processing that they're doing for you, because they're just taking the data you give them and processing it. And then they've had an audit firm come in and review those processes, and they write a report on it. And those reports are quite lengthy, but they also include something called user controls. And the users are plan sponsors. So what they're saying is, for example, you need to submit accurate census data and have some reviews in place over what you're giving us, because we're just going to process what you give us. So they're going to spell out probably a dozen user controls that they're anticipating that you're doing in using their services. So you want to take a look at what those are and make sure that you're actually doing them. I often pull those out of those reports and give them to clients and say, hey, how are you guys addressing these? And too many times, it's the first time they've seen them. So check those out early and often and make sure you're complying with them. When it comes time to select an auditor, the AICPA has been obviously working with firms, reacting to these quality studies and whatnot, trying to find ways to improve quality. And one of the things that they have done, they have set up a quality center. Membership is voluntary. Our firm is a member of it. Many firms are. I'm a big supporter of it. Being a member simply means that you're going to get additional education opportunities. You're going to be held to a little bit higher standard when it comes time for peer reviews and that sort of thing. More of your files are going to be looked at. So firms that are a member of that center are a very good first step in identifying a firm that does quality work. Look for somebody that has experience with qualified plans and maybe some other industry designations. There are some organizations out there that you guys might be familiar with, ASPA, SEBS, a few others that provide some qualified plan sort of education and whatnot and designations. So maybe look for somebody that is involved in those organizations. And then really, I'm big on time, right? We all have calendars, right? I sit down with my clients, I say, hey, let's try to do this, then, get through these steps so we can all get on with our life, and I can get back to the golf course, and you can get back to whatever it is that you enjoy. And let's get these things up and down. Let's get them done. We can do this together as a team. look for someone that's willing to do that and was not going to be sending you a report at 3:30 in the afternoon on October 15th, and you're scrambling trying to get the darn thing filed. So those are some thoughts for you on some best practices as I wrap up